All right, good morning. You're welcome to another session of Business Mathematics, UGBS 202. Today we'll look into capital investment appraisal. Now, just as the name says, well, we're doing business mathematics, and so lots of the times we would want to put into perspective all of these mathematical disciplines or mathematical concepts into business perspectives. Businesses make lots of investment decisions, and you would want, or in any rational sense, businesses would want to make decisions with regards to their investment based on certain information or prior information. And so with regards to these cases, normally businesses would want to find out how soon they would recover their investments, or maybe what the returns would be, or the present equivalent of whatever they're investing today over some time period. So we are going to look at certain techniques that are used to evaluate investment options or appraise investment options, as we can say. Regarding this topic, we will look at a concept as payback period, which will look at the discount approach and then the non-discount approach. And then we'll also look at net present values, internal rate of returns, and maybe there are some other techniques as we move forward. So we'll start with the payback period approach. This approach basically looks at how soon a business is likely to recover whatever investments it has made over some time period. And so the point of reference or the analysis of essence here is to identify the time period, the shortest possible time period that a business would possibly get back whatever it has invested in a project or probably some capital. And so under payback period, we'll look at two basic approaches. We'll look at the discount approach and then the non-discount approach. When we talk of a discount approach, then this approach we consider the time value of money or the case of interest rates. When we talk of the non-discount approach, then we are assuming there isn't any issue of interest, and so we wouldn't consider the time value of money. The simplest one is the non-discount approach, where we assume our interest rate is zero. And so we'll consider that one first, and then we go forward and look at the other options. Okay, so let me get the cursor here. Okay, so this is basically the mathematical expression of how we are going to go about the non-discount approach of evaluating our payback period. Our CO here, or C subscript O, refers to our initial investment. Now, we are saying that our initial investment minus the sum of all cash flows over subsequent periods. And so the assumption is, supposing we have a certain investment, which is supposed to yield some cash flows or inflows specifically over some time period, we just want to evaluate at what time period would we recover our initial investment, which is CO. Or possibly, at what time would the difference between the CO and the inflows become zero? Right? So you look at the inequality sign here, it says should be less than or equal to zero. Now, the moment this ratio on the right-hand side here becomes a value which is less than or equal to zero, it is an indication that by that time we have recovered whatever investment we have made. So let's consider an example. We say a business project is being considered which has 22,000 as the initial cost associated with revenue over the following 4 years, or as this. So we are assuming that we are investing 22,000, and then the potential returns over the periods are in year 1, 8,000, 12,000, 10,000, and 6,500 respectively. So what is the payback period of this investment? Now you notice here that we are not given any interest rate, meaning that we are assuming that our interest rate is zero. And so here we are not considering the time value of money. In other words, we are saying this, we will need a non-discounted approach. Now we express our expression as this. So CK here is the yearly inflow or the periodic inflow of cash against our initial investment. So let's take the first instance. Now, supposing we want to do this on a step-by-step basis, the procedure would be, in the first instance, if I take my initial investment, which is 22,000, what comes in the first year is 8,000. I do this deduction. And obviously, if I take 8,000 from 22,000, it's obvious I still wouldn't have recovered my entire investment. And so it is again obvious to say that we would not be able to get the total the 22,000 in the first year. And so let's consider the case of the second year. Now, so if we add the second year, then this time around what we have is another 12,000. So 12,000 and 8,000, this time would be 20,000. We find the difference between this, we'll have 2,000. It means we are still not done recovering our entire 22,000, which is the initial investment. And so let's consider the third period, which brings in a cash flow of 10,000. Now, if I put these three values together, 8,000 plus 22,000 plus 10,000, you notice that the sum of these three values over this 3-year period will be greater than the 22. Now, if I take all these three out of the 22, I'm going to have a value of minus 8,000. Now, this value here is less than 0. Now, you see the expression here says that, now supposing the value turns out to be less than or equal to 0, the period within which our computation gives us this value, which is less than or equal to 0, that period will be considered as our payback period. Now, this 8,000 occurred in year 1, 12,000 in year 2, and 10,000 in year 3. And so the assumption here is that in year 3, we would have recovered entirely whatever we invested in this project. And so here, our answer is the payback period is in year 3. Very simple approach. That's why we say it is the easiest of the payback methods. Okay, so how about we consider the case of the discounted approach? Now, with the discounted approach, it is also similar to what we just saw, but the idea here is that this time around, we are considering the time value of money. Now, in considering the time value of money, it means that before we do any deductions from the initial capital we have invested at period 0, we would have to discount it against whatever interest rates we have. Now, we are saying that here, you see, in this case, the value of money today will not be the value of money tomorrow. That is the idea of the time value of money. So supposing we have an interest factor, we would have to discount whatever the inflow is using this expression, CK, which is the inflow as at period K, divided by 1 plus I to the power K. And so this is just the basic analogy. Let's take an example as this one. So I explain what the concept means using this question. Now we want to evaluate the purchase of two machines, machine A and machine B. These are the years. So we have years 1 to years 4. Now, machine A would cost us 50,000. You do notice that in period 0, here, period 0 would mean that is the initial period, kind of like today. If you cast your mind back to what we did regarding the cash flow diagram, period 0 refers to today. And so if we are supposed to acquire this machine today, we would pay 50,000, and machine B would cost us 45,000. And so you notice that it has a negative value, indicating it's an outflow. So the idea is if we are buying, well, then it's money leaving our coffers. But supposing we acquire this machine and this machine starts working for us, in the subsequent years, the machine will probably be useful for 4 years. And over the 4 years, the machine would give us some revenue. In year 1, for instance, for machine A, it is projected that it should bring us some revenue of 25,500. In year 2, 24,500. In year 3, 17,000. And in year 4, 14,000. The same applies to the case of machine B. Now, if we are supposed to decide on which of the machines to acquire, what we want to do here, using the discounted payback period technique, is to say that we are going to evaluate the payback period of these two machines independently and find out the one that gives us the shortest possible time or pays back our investment within the shortest possible time. The machine that gives us that kind of period or the shortest possible time should be the most viable machine. Like I said, we say that this approach only considers the time frame within which we are supposed to recover our investment, which in this case is 50,000 and 45,000 respectively. So let's consider this and go over this process as well. So let's try and solve this question. So from the table, this is the formula. Our CO here, which is the initial investment, minus the sum of all investments, K, where K goes from 1 to N, when 1 to N means, in our case, we have years 1 to 4. Okay, so I discount each of the cash flows and then I subtract. If it does not give me, or it doesn't take this value to 0 or a value less than 0, it means I still have some investment or some money left to make up for. So I'll keep doing the discounting and subtracting it from the initial investment until I have the value which is less than or equal to 0. Now please remember that where we are discounting before we do the subtraction, the assumption is that our interest is greater than 0. It means here we are considering the time value of money. So let's look at it how we went about it here. Now, machine A has an initial investment of 50,000, which is here the same as my CO. The first cash flow here is 25,500 in year 1. And the interest rate given or quoted was 15%. Said we are saying that which of the two machines should be chosen on the discounted payback period if the interest is 15%. And so here I take the 25,500, I divide by 1 plus I, and then our I is 0.15 or 15%. And obviously here the N would be 1 because this is year 1. Take your mind back to the cash flow diagram. We would only move one step from year 1 to the 0 period. And so I do this discount and then I take it out from 50,000. If it doesn't cover for the entire 50,000, then obviously I will still have to go ahead and consider the next period. And so here, if I discount this, it's obvious that it will not be up to 50,000. So I go to the next one, then I discount this one, then to 24,500 divided by 1.15. This time, this is occurring in the second year, and so it will be raised to the power 2. N will be 2 years. Now, whatever this expression gives me, plus whatever this gives me, I deduct it from 50,000. If it doesn't give me something equal to or less than 0, I would have to consider the next. It means that as at the second period, we still wouldn't have finished recouping our entire investment. And so I consider the third period as well, which is 17,000. And so it is 17,000 over 1.15 to the power 3, because this is in the third year. Now, when I do this, it will give me a certain value, plus this value, plus this value, and I deduct it from 50,000. And in our case here, when I did all the three, we had minus 1,877.21, which is less than 0. So it means that, well, somewhere in the third year, we would have been done recouping or catering for this 50,000. And so if this machine works for 3 years, by the third year, we would have recovered our entire investment. And then we can just say that the payback period will be in year 3. We do a similar thing for machine B. And so for machine B, we do for the first year, the second year, the third year. And I noticed that for machine B, we would recover our investments in the fourth year. And so if you were using this approach and one machine would recover the initial investment in period 3, and the second one would recover it in period 4, the option to choose would be the machine or the option that gives you the shortest possible time. In fact, that is what the payback period approach or technique says. And so here our decision will be the company should choose machine A over machine B. Why? Because machine A has a shorter payback period. Okay, so that is it for the case of discounted and non-discounted payback periods. Now, there's something, let's say, a little peculiar about this. You do notice that the inflows happen to vary from year to year. And so we had to use the present value approach, which is for just a single value. Now, how about the case of we having a uniform cash flow? Now, for instance, we want to acquire a machine that probably would give us a certain fixed sum over a certain period, over the useful life of the machine or the capital we want to acquire. And so the idea is just the same. We only cast our mind back to the previous expressions that or formulas that we've dealt with in the financial mathematics section. Now, given the case of the uniform cash flow, we can also look out for or apply this same technique where we calculate the payback period under some uniform cash flows. And the story isn't different from what you have seen before. And so in finding the present value for uniform cash flow, this is the expression. Now it follows the same thing that we were doing here, or the same concept. The formulas are not necessarily the same, but the concept or the idea is the same. We discount whatever inflows that we have, and then we deduct it from the initial investment. But in the case of a uniform cash flow, well, we are going to adopt some, let's say, a little try and error kind of method, because sometimes, because we are going to be using this expression or this formula that can put in all the years at once and then find out the present value for you. Now, the period could be so long so that you can afford doing this over and over and over again. And so we'll go through some basic approach in seeing how we can use some try and error approach to identify this or to solve or find the payback period for some uniform cash flow. So let's take this basic example. Supposing that a company is evaluating the following mutually exclusive projects at an interest rate of A, 0%, and then interest rate of B, 6% per year. Now, this is project A. The initial cost is 200, and then project 2, the initial cost is 100,000. And then the annual benefits is 26 for project 1, and then 15,000 for project 2. And then the useful lives of the project life for project 1 is 16 years, and for project 2 is 10 years. Now we want to find the payback period for both projects, assuming that we do not consider interest rates, or we do not consider the time value of money, where our interest rate is 0. And then the second instance where we'll consider an interest rate of, say, 6%. Now, which project do you think we should select? So let's go through this process or this example and then see how we'll apply the formula. Okay, now, if we are not considering the time value of money, where our interest rate is 0, or where we assume interest rate to be equal to 0, then here, the only thing we do for a uniform cash flow or a case where we have the same amount of money or the same amount of inflow or cash flow or outflow, the only thing we do is we only divide the initial investment by the periodic inflow or by the annual cash flow, the annual amount that comes in periodically. It's just like saying, if you want to find out the number of years, how many times would the initial investment, would the annual inflow go into the initial investment? And so in the case of where I is equal to 0, we have CO divided by A, where our CO is the initial investment, and then the A is the annual inflow or the periodic inflow. And so here, our initial investment from the question for project 1 was 200,000, and the annual benefit or the annual returns is 26,000. Now, if we find this ratio, we do this division, what we have is 7.69, which approximately is 8 years. Right? So we are kind of saying that without considering the time value of money, project 1, by the 8th year, we would have probably recovered our investment or initial investment of 200,000, and maybe the subsequent years will really be making profits for us. Now we do the same for project 2, and it is 100,000 divided by 15,000, and what we have here is 6.67, which in other words is say approximately 7 years. Now, considering these two solutions, or these 2 years, given that we are not considering the time value of money, we should select project 2. because it has the shorter payback period. Now let's look at the other instance where we now want to consider the time value of money, where our I is greater than 0. Okay, so what we do is we still take the initial investment and then we discount the inflows and then we find the difference. Now you see here we are using this approach, and I'm sure we all remember this expression, which is going to give us the present value for a uniform cash flow. And it's the same thing. The previous instance, the cash flow wasn't uniform, and so we had to take the present value formula that is used for just a single amount. In this case, it is uniform. And so the expression says it is A over I over 1 plus I to the power n minus 1, all divided by 1 plus I to the power n, where A is the periodic inflow or the annual sum we get, I is the interest rate, n is the years. Okay, now here, you remember I said we kind of will adopt a certain try and error approach because we cannot hit with specificity when exactly our difference between this value and the value of this entire expression would be less than or equal to 0. And so given a project, say project 1, that has a lifespan of 16 years. Now what I personally would advise you do is, now taking this project, you do know that when we discount the value, when we discount the periodic sum before we subtract, we kind of will get a lesser sum or value. And so this is a simple trick that I advise you do. Now, considering this value, if you come back where we do not consider the time value of money, right, where we just take the absolute value, let's say 26, and just subtract it from 20 and we do it, we'll do it for 80 years before we recover our initial investment. And so I advise that if you start with this, if you're going to use for the cash flow, where we want to consider the interest rate to be greater than 0, then do not consider any period less than 8 years because, well, even when we consider the full sum, it is up to 8 years. So why would you want to consider some period less than 8 years? You'll be wasting your time. And so consider any period from 8 years and above going. And so it works for all other techniques as well. Now, supposing you're just giving any annual amount which is supposed to flow over a certain period, just do the initial investment divided by the annual amount so that you use it to eliminate some years that you don't have to waste your time doing. So in my case, well, because I know that even if I take out 26 from 200, I'll do it 8 times before I will recover this. Now, supposing I'll have to discount this 26 before I subtract, then obviously the value of 26 will be less, and so the years would be kind of many. And so I eliminate the first 8 years, sort of, and then so I started from period 10. Now, when I do it for period 10, so I take my 200,000 minus, I substitute all the values into this expression. So my A is the 26,000 divided by 0.06 and then 1.06 to the power 10, because now I'm starting in year 10, and I do it. What I have here is 8,637.4, which even at year 10 is still not less than or equal to 0. So what do? It means I also have to probably do another one. And so I move on to period 11. So I take period 11. When n is 11, I do the same thing. And voila, look what I have. Now I have minus 5,058.74, which in actual fact is less than 0. And so it is kind of telling you that between period 10 and period 11, I would be recovering my money. And obviously, as at period 10, I hadn't recovered my initial investment of 200,000. And so it is obvious that in period 11, I would have been done paying or recovering the entire 200,000. And so my payback period for this uniform cash flow, where my interest rate is 6%, which is greater than 0, is in year 11. Now, given the trick I said, please also consider the interest rate. Now, when the interest rate is high, you would see that the periods would be lesser, but if it's not that high. Okay, in my case, the interest rate is so small, 6%, so, well, we would have to go up to about period 11. But, well, I'm pretty sure you can all go over it. So you do the same for machine B. And so for machine B, well, I did it for period 10 again, and then I had a negative number. Good. Now, once I did it for period 10 and I had a negative number, well, someone could say that, well, in fact, I'm done paying by period 10, but you would have to be sure whether it was in period 10. My first choice gave me a negative value. So I may want to be certain that it is actually period 10. So I would go back and do for, let's say, period 9, just to be sure. For all you know, period 9 could also give me a value which is less than or probably equal to 0, which in that case, I would be getting my solution wrong. And so you go back and I do it for period 9, and then I notice that period 9 also gave me a negative value, you see. So here, it means I kind of chose a way bigger n value. Well, but I confirmed again, I did it for period 8, and still, well, I had a positive value. So obviously, well, my payback period for this will be period 9, right? Because here, period 9 also gives me a value which is less than or equal, which is less than 0, right? But if you do this for period 8, supposing you take this entire expression and you change the period here, 9 to 8, you see you have a positive value. And so here, that's a confirmation that here, our payback period is period 9. And so the payback here is period 9. Well, okay. So now, your decision, your final decision would be to choose the machine that has the shorter payback period. Now, in this case, it's period 9, and in the previous case, it was period 11. And so, obviously, I would choose machine B, which again is consistent with what we had when we did not consider the time value of money. Well, I don't think it is always going to be the case, but most of the time, let's say 90% of the time, it is likely to be the same. Or let me even say 95% of the time. Okay. So that is it about with the payback period approach or technique, where we use the discounted approach and then the non-discount approach for irregular cash flows, and then for regular or what we call the uniform cash flows. Now let's look at another capital investment appraisal technique, which we call the net present value or the NPV. Now the NPV is more like a little build up on the payback period. Now the payback period approach has certain flaws that this approach actually comes to rectify. Now you see, the payback period basically considers the time frame or the period within which we recover our investment. That is the only thing of interest to that technique. And so it does not necessarily consider what happens after the subsequent periods or the periods after the payback period. Now consider this expression. Now look at this. Now supposing that from our example, this project is supposed to last for 16 years. This is supposed to last for 10 years. Now here we found out that the project would recover our initial investment in the 11th year. Now after this period, there are some more years, at least about 5 years to the 16th year. What happens in those periods? But you notice that this technique doesn't necessarily consider what happens, but those periods could also be of great use to us because they probably would be bringing us some revenue. And so we will want an approach or a technique that considers all periods in the useful period or in the useful life of the entire project. And so what the NPV approach brings on board or adds up to what we just saw before is that, well, it actually considers the entire life cycle, the lifespan of the project, and then considers every inflow or all the inflows of the project, and then discounts them, finds the total, and then find the difference between that and then the initial investment. If it is a positive value, then the project we can say is viable. If it is a negative value or something less than 0, we would say the project is not viable. Now, if it is equal to 0, then at that point, we would say that, well, the project it kind of gives us some break even. We do not make losses, neither do we make profits. Now, it is more like, think about it like finding the difference between your expenditure and then your revenue. It's like, so what is the formula for finding total revenue? You say it is your your finding your profit is your total revenue minus what? Your total cost. So what this does here is it considers all the cash flows here. So the sum of CK over 1 plus I to the power K. So all the cash flows, we discount them and sum them, and then we subtract it from the initial investment. Then the difference will tell us whether the project is viable or not viable. Very simple approach. So it kind of builds up on what the flaw of the payback technique, which does not consider the periods beyond the payback period. So let's consider this question, the same one we used for the payback approach. Now this is machine A and machine B. This is the initial investment, 50,000 for machine A, 45,000 for machine B. And these are the yearly cash flows for these two machines. Now, in using the payback period, what it says is we are going to take all these values, discount them and sum them. And then we take the total and find the difference between the total and this initial investment. Okay, so that's why we have this sign here, the sigma, the summation sign here. So let's look at it. So this is what we do. So to find the NPV for machine A, I take 25,000. Okay, so forgive me, I didn't tell you what the interest here. So here we say the interest is 20%. Now please bear in mind that the NPV approach is a purely discounted approach. We don't have a non-discount approach for the NPV. So for the NPV, it's a discount approach. So all the time you are going to have an interest element or an interest rate for the NPV approach. So here, this is for the first period. So you see, my interest rate is 20%, which is the same as 0.20. So here the formula says CK, which is the inflow as at period K, divided by 1 plus I, and then my I is 20%, so in this case is 0.2, to the power K. Now the period is period 1, so here we do not have any power here. Well, it will be the same. So 25,500 divided by 1.2 plus 24,500 over 1.2 to the power 2, then 17,000 to the power 3 to the power 4. Now what do you see? Here what we do is I do it for all of these. I do it for all of them. And then we sum everything. Okay. So now hold on. Do not consider this value here yet. I will explain what is there and then it's another portion of the question. So do not worry here. But what I do here is this year, I discount all these values. I sum them. And then after summing them, I find the difference between the total of the discounted values of these three inflows. And then whatever it gives me, if it's a positive ratio here, it means that our revenue is greater than the initial cost. So in that case, if your revenue is greater than your expenditure, what is it? It's a profit. I hope you understand. Now, supposing we did it and then this side, my cost was greater than my revenue, then you notice that I'll have a negative value here, which means that it is a loss. Now, supposing it ends up being 50-50, and so here, when I find the difference between this side and this side, I end up getting 0. Well, it means that I don't get anything. I'm not making losses, neither am I making profits. And so the same applies to machine B. But look at this, a very interesting case here. Now, the second part, the question said that assume machine A has a scrap value of 5,000 and machine B has a scrap value of 4,000. Now, what are scrap values? Just another name for it. Some accounting, if you're doing accounting, in other words, you call it residual values and all that. Now, there are certain machines or certain instances when the machine has exhausted its useful years or is done being useful. You could probably sell it off at some reduced value, which we call the scrap value, right? So for instance, if you have a broken down car and you cannot do anything with it, the engine is broken, nothing. Well, you have some people who actually buy scrap. They will take it and go probably sell it to some steel maker or something. And so you can also recover some money from that kind of venture. So this value, we say that the machine A has a scrap value of this, 5,000. Machine B has a scrap value of that. Now, you see, this situation occurs only in the final period. Now, when the machine probably has exhausted its useful period. And so but we are assuming that here, in this case, machine A is expected to last for, let's say, 4 years. So after the 4th year, we kind of will dispose it off. And the disposal value here is 5,000, or kind of when we sell it out in that broken down state, what we get is the 5,000. Now, you can bear with me that this 5,000 is also some revenue, right? So if you look at it from my solution, what we do here is, in the final year, that revenue which we get from disposing of that machine, or machine A, which is 5,000, we add it to what we get from the useful operation of the machine. So in this case here, we are not going to get 14,000, we will get 19,000. And then we'll discount it by this 1.2 to the power 4. I hope we understand. Now the 5,000 here is the scrap value, and it only would occur in the final period, or the final year. In fact, you can only dispose a machine of after it has exhausted its useful years. And so here I add this 5,000 to the 14,000, I have 19,000, I discount it. Then the sum of all these values here minus 50,000, what I have is this. So now I have 7,264.66. Well, this is a positive value. It means that machine A is profitable. I do the same for machine B. And then we have, so this time around, this 4,000 here is again the scrap value. Okay, but supposing we are not given any information concerning scrap value, you only discount this value and then you find the difference between the 45,000. Here we have 8,587.962. Now, both of them have positive values. It means that both machines, when acquired, potentially would give us some revenue. Now, consider them. You see, this is another twist to the case or the concept of NPVs. Now, when both of them have positive values, you select the option that has the higher positive value. I think this is a simple decision to make. In business, the motive for any business venture is to maximize profitability, and so more is always preferred to less. Now, if machine A will give me a profit of 7,264, and then machine B will give me 8,587, obviously I would prefer machine B because it gives me a higher profit. Okay. Now, we can also do or apply this NPV approach for the case of some uniform cash flows. Okay, so now we also take the same example we solved as before. So I have my project 1 and project 2. Initial cost for project 1 is 200,000, 100,000 for project 2, 26,000 as annual benefits for project 1, and 15,000 for project 2, and then 16 and 10 years respectively. And then we also have the interest rate for the period for the projects at 6%. Now, the good news here is we do not do any try and error. All we do is we take this information, substitute it into the formula that we have, and then we will just evaluate it over the 16 years, find the total, and then subtract from here. So look at it from this point of view. So this is the expression to find the present value for some uniform cash flow. And so here, I do all these minus the CO. And it's the same concept given the case of the irregular cash flows as well. I discount it. Whatever the total sum is, then I subtract from the initial investment. It's the same idea. And so here, for project 1, my annual benefit is 26,000 divided by the I, which is the interest rate, 1 plus 0.6, which is what this expression says, to the power 16. You see, so I'm evaluating it over the entire period. I do the same, minus 200,000. What do I have? I have 62,753.28 for project 1. I do the same for project 2. Okay, so once I do the same for project 2, I have 10,401.306. Now, compare these two. Which would you prefer? Like I said before, if both are viable, you choose the one that is most viable or the one that has the highest returns. And so in this case, it is project 1. And so my final decision based on the NPV approach would be to select project 1. Okay, so I hope you enjoyed this section and you understood the concept put forward. I'll see you in the subsequent sections. Goodbye.